Hello again, Simon here with your Accelerate free video update. And the big news on Friday was the employment data with non-farm payrolls coming in at 235,000, which is a fair way short of Wall Street expectations for 725,000 new jobs being created. That figure was a 7-month low, and the unemployment rate came in at 5.2%. So the question is now being asked whether the unemployment rate is getting close to what could be considered full employment, even as 5 million fewer people are employed compared with pre the pandemic. So why might that be the case? Well, one possible answer could be wage growth. Because wage growth came in at 4.3%, which is certainly kind of hotter than we've seen any time since 2008. And it's running slightly hotter than inflation rate, which the Fed continues to exist is merely transitory. Now, the miss is being blamed on a number of things, namely the Delta variant. But there's also significant noise around summer seasonal adjustments to this data series and a certain amount of confusion over employment benefits or unemployment benefits. Now, at his Jackson Hole speech, Powell did tie the tapering decision to continued strong employment data, and obviously this is weak employment data, and as you can see from this headline, there is an emerging view that a September taper is far from a certainty, and in fact this tapering decision by the Fed may get kicked further down the road. All of this probably means that we've got to wait till at least the next FOMC meeting on the 22nd of September and probably wait and have a look at the October employment situation and any revisions that are made to this month's data to get a clearer picture on what the Fed is likely to do or not with regards to tapering. But we've got a situation where inflation is starting to look a little bit sticky, and we've got the Wall Street Journal asking, how does the Fed deal with above target inflation? Well, raise the target. This is because, like I said, inflation data is remaining sticky. Wage growth is looking quite strong. And then combine that with a situation where, maybe the global economic recovery is starting to roll over a little bit here. The pandemic, particularly the Delta variant, refuses to leave the headlines, which is leading many to the conclusion that maybe global growth is about as good as it gets right now. And you can see PMI activity across large parts of the globe starting to roll over. So these signs of potentially sticky rather than transient inflation, combined with economic growth that's starting to roll over, raises the spectre of what was once known as stagflation, which is a stagnating economy combined with inflation. Not the most benign investment scenario. Now, like I said, this is all conjecture at this point, but if stagflation is what's in our future, it could break some relationships that have been fairly long held, and I'll explain what I mean in the next slide. So this is a concept I've been talking about for a while. It's something that I call the reflation seesaw. On one side of the seesaw, we've got a weaker economy with falling inflation expectations. This is a disinflationary/deflationary scenario. In this environment, bonds will rally because money will want to move into a safe haven. That will cause yields to decline because people will bid up bonds. A small return is better than a negative return in a deflationary environment. That will lead to a flatter yield curve. Generally, tech stocks will outperform in this environment. Cyclical stocks will underperform, as will things like commodities. On the other side of the seesaw, we've got stronger economy, rising inflation expectations. This is the reflationary camp, where bonds are weaker. That causes bond yields to rise. It steepens the yield curve, which is beneficial for banks and financials and industrials and cyclical type stocks. And generally, commodities will perform well in that environment too. But a stagflationary outcome is going to change the balance, because there we're looking at potentially a weaker economy combined with rising inflation expectations. Now, what we've seen really for several quarters now is when bonds rally, tech rallies, and when bonds fall, tech falls. All right, bonds fall, cyclical stocks tend to rally. What we might end up seeing is a situation where If stagflation becomes the default view, the consensus view, bonds could fall, but tech stocks could actually rally. Why? Well, the reason tech stocks and tech stocks have performed so well really since 2008 is because they've been the beneficiaries of secular growth trends. Think about online advertising, e-commerce, software as a service. And a lot of these tech companies have got high margins, strong pricing power, and they're still in industries that should experience strong growth, even if the broader economy is growing at a fairly moribund pace. Okay, so this relationship that I've drawn in the reflation seesaw has held pretty strongly for several quarters, but if stagflation takes hold, we could see these relationships break down. So I guess my main message is don't reflexively think that just because bonds sell off, tech is going to sell off, just because that's been the correlation that has held now for the past several quarters. We may be on the cusp of a regime change, and I think the next couple of months will certainly be enlightening in that regard. Anyway, I think it's an important topic to be aware of. I hope it helps, and I hope to see you on my next update. Thanks for watching. If you like this video and you'd like to receive more insights, remember to subscribe to my channel, and I'll see you next time.